You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. Welcome to the show, Keith.
Jim, thanks for having me on.
The big disconnect people keep wondering is how come oil prices are now down into the high 30s and we're still paying $1.25 a liter in Vancouver?
Yeah, that for consumers that sucks. That's a tough one to swallow. But the reality is that our Canadian dollar is a big chunk of that. Like back in January, Jim, our dollar was probably 92 cents, and now it's 75 cents. So you're talking about 17 cents that it's dropped. So when you think about that and our gas price, so if you think that 17 cents even off 92 cents is like 20%. So 20% of our gas price right now is a lower Canadian dollar. And when you're talking about $1.20 a liter, that's 25 cents. So, if our dollar was even where it was in January, we'd probably be sitting at a gas price around the country that would be 25 cents a liter lower, which would put it right around $1. Like here in Vancouver, it would be $1. In most of Canada, it would be under $1 a liter. But that has been the big driver. And certainly out here in the West Coast, as we've talked about before, it's a much tighter gasoline market because of the refineries that are down in California. And we really have quite an integrated market with the States. So that's what's happening. And I guess the third thing would be that, refinery profits are up a lot because demand in the U.S. especially is way up, like 800,000 barrels a day. For oil, it's over 1 million barrels a day. For gasoline, it's something like 600,000 barrels a day. So when you've got increased demand, you are going to have higher prices.
Yes, I've heard SUV sales in the U.S. have skyrocketed since the lower oil prices.
Yes, and see, in the States, they have had a bigger drop in gas. So they've gone down about 33%, maybe just a little more than 33%. Gas back at last year was averaging around $3.80 a gallon there. Now it's down to about $2.60. So it's that's a much bigger drop in gasoline prices than what we've had here in Canada. People
are wondering if the oil patch is suffering right now, what else can go wrong?
Oh, Jim, when you look at what's happened in the last 6 months or a year, it's pretty incredible. So when you look at, we've had oil prices collapse, and then we've also had what's called the differentials, the discounts that Canadian oil has to get to U.S. refineries. That's gone way up. So not only has oil, let's say heavy oil, gone from 60 to 30 or 60 to 40, the discount to U.S. oil has gone way up. So that's just been really, really tough. So and then Mexico's actually, even though their oil production is declining, they've just signed a deal with the United States to swap out 100,000 barrels a day, roughly, of heavy oil for light oil. And because all of our Canadian oil is heavy oil, that's basically 100,000 barrels that we can't send to the Gulf Coast that we used to. So there's that. And, on the gas side, like, it's as bad or worse in the sense that we've had so much gas come out of the northeast U.S. now with this new discovery called the Marcellus Formation. It's totally turned the gas market upside down, and they've displaced a lot of Canadian gas all over the eastern side of the continent. And now, get a load of this, Jim, only about 5 years ago, Kinder Morgan spent $6.5 billion building this massive pipeline from the Rockies to Ohio to ship all the gas into eastern U.S. And because of this new discovery, they don't need it, so they're reversing it. And they're sending all that gas from the northeast U.S. into Chicago and the Rockies, and that's just going to displace even more Canadian gas. So it's going to be tough. We've really had the screws put to us by both the market and just our own inability to really kind of manage production.
How's that giant pipeline from Russia to China going to affect Canada?
Not yet. The reality is that we've still got a big surplus, so that's not gonna make a big deal for us. It really would potentially lower LNG prices, but until we actually have an LNG industry, Jim, I don't see that really impacting us. And frankly, gas prices have come down so much that I wouldn't be surprised that deal doesn't go ahead. but we'll see.
What about the plan to build an offshore natural gas refinery in BC? Is that a doable project?
Well, yeah, that's called floating LNG, and if it happens at all, Jim, I think that's got the best shot at making it because it's much smaller scale, so it's much lower cost, and not only is it lower cost, like most of that cost is actually on the ship, which can be moved around the world if the economics in Canada don't work. So the actual dock that stays on the land, that's only probably about $600 to $800 million. Now, you might say, Keith, that's a lot of money, but it's sure a lot less than the $7 billion it would take to build one of those massive land-based terminals.
We'll have more with Keith Schaefer right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. Keith, Shell Oil says it's going ahead with that project to drill for oil in the Arctic. Hillary Clinton is against it. Obama says, go ahead, boys, drill all the way. Why can they afford a $7 billion project with such low oil prices right now?
Well, I think what's happening, Jim, is that these companies, the larger companies in particular, have a much longer timeline on their horizon than investors do. You know, we're so myopic as investors now, only looking 1 to 2 quarters ahead. But the reality is, these energy cycles take a long time. And even though they're just starting to drill now, the reality is that even if they were successful, they wouldn't be producing out of that probably for 10 years. Well, nobody knows what the price of oil is going to be in 10 years. Nobody. So nobody knows what it's going to be in 10 months. So I'm not. It just makes sense that somebody is willing to push the envelope a little bit, source a new supply of oil for the world. That if we need it, great. If we don't, well, that's Shell's issue, not ours. So it's great that private industry is stepping up here when costs are low, because that's the other thing, is that cost escalation through the last 4 years, Jim, with $100 oil has been huge. You know, these labor costs have gone through the roof. So now we're seeing our first dramatic pullback in labor costs. So you could argue easily that this is the time to be doing that.
An interesting side effect of the low price of oil in Alberta, I've been told that the repossession companies are going absolutely nuts trying to collect RVs, SUVs, high-end cars because the oil workers can't afford to make the payments anymore.
Well, Jim, I've always said there's a bull market somewhere in energy all the time, and now you've just told me about another one. So I'll see if there's any stocks that do that, because that's what I do. So, but thanks for that tip.
I was going to say, head up to Grand Prairie and Peace River and buy yourself a real big tow truck.
Mm-hmm.
Are we seeing any major acquisitions yet? I heard Schlumberger's making a $14 billion deal to acquire another company. Are we going to see some majors going after smaller players now?
You know, that deal kind of surprised me. I'm with everyone thinking that oil is going to be lower for longer. You would think that the M&A activity should get cheaper as we go longer into this oil price pullback. But what I'm seeing, Jim, is that the amount of private equity that's sitting on the sidelines waiting to pounce is, I think, really artificially keeping transaction prices higher than they should be. Like, both on the services side and on the production side, you're seeing deals get done at in my mind, pretty much the same as pre-crash prices. And I don't understand that. You know, you're talking about doing a deal where it's going to take 10 years to get your money back out of cash flow, or even more. That doesn't make sense in any market, but you would think that at some point in time, people are going to start to get so desperate that, and banks are going to really start putting the screws to these companies, both on the service side and the producer side, that they're just going to have to accept whatever bid comes in. But like I say, the patch so far hasn't shown any inclination to lower transaction values. So that to me, that's a big surprise. And I think a lot of it has to do with that, particularly on the bigger deals. You got all this private equity money sitting on the sidelines just waiting to go, and that stuns me. It makes no sense to me, but probably just means there's going to be another round of M&A 2-3 years down the road when these guys realize that they've made a mistake.
Do you think perhaps there's continued optimism in the oil patch?
Well, yeah, because there's one simple law here that is in the back of all the minds of the producers, and that's that there's only 4 million barrels a day at most spare capacity in the world right now. And we lose about 4 million barrels a day to natural declines a year. So that math is pretty simple. Like, literally within 1 year, all that excess supply could be eaten up just to keep production steady. So, again, that's why Shell's drilling in the Arctic, and that's why, maybe asset prices haven't really come down that much. And
also, I think, Keith, you explained that wells that are done by fracking do not last as long as the traditional oil well does.
No, that's not necessarily true. I would say, Jim, that we don't have the production profile of any major asset that would tell us that. But so far, I'd have to say the Street has been surprised at how strong these shale wells produce later in life. Like, we're all used to hearing the phrase, okay, they lose 65 to 80% of their production in the first year, and then 40%, then 30%, then 20%. But what we're finding these days is that what's called the long tail of production after the first big declines have happened is actually pretty strong, and these wells can be refracked to get even more production out of them. And the other thing we're finding is that as wells get shut in, even with tight oil, the production on existing wells the decline slows even more. So basically, the fewer straws in the drink, the more drink comes up the straws that are there. So it's actually been surprising to see how strongly that production has held in.
Well, fracking, although it's been happening since the 40s, with new technology, it changes every day. So what held even a year ago isn't true anymore.
Yeah, that is so true. Most investors would be stunned to know that many producers across Canada and the U.S. are seeing 20 to 30% increases in efficiency in 1 year. When we thought that all the big jumps in efficiencies were done and we were now just going to start to see incremental ones, different things have come along that have allowed 20 to 30% increase in production for the same cost, and now even less cost because service costs have come down. So it's pretty remarkable, and I'm sure that's one thing the Saudis are really scratching their head about now.
Somebody said because of fracking in the U.S., they could actually have the Saudis go bust in a few years. Do you see that as being real?
Oh, that'd be a lot of years, Jim. Not sure how much I'd want to believe that one. I would say they've got 3 to 5 years with just kind of, I'd say, minor to medium pain, but I don't think they really have to revisit this strategy for at least 3 years. So,
Keith, thanks a lot for chatting with us.
Jim, God bless you. Have a great day.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, the website oilandgas-investments.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our very popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.